experience in the third quarter was not nearly as bad as I thought. You know, one data point, not necessarily related to earnings, that I really love, because I love reading these CFO surveys, and the Richmond Fed Duke Fuqua CFO survey, which was released for third quarter data, had some interesting tidbits. And one of them was companies did not report any deterioration in their own conditions second quarter to third quarter. It was actually still relatively elevated. And while there's a big gap between how companies think about the economy going into 2023 and how they feel about their own businesses, that gap has persisted for a couple quarters. So there's not been a big deterioration, and I think it's going to be hard for companies to sort of give us strong guidance one way or another when there are so many macro variables that are uncertain, as Andrew Sheets was just mentioning in that clip you played.
Okay, it's something about what we can learn about the president, what it tells us about the future, and I'll build on that. This is what we're learning about the president from Wall Street chiefs. Moynihan at Bank of America says consumers are spending. Diamond at JP Morgan says consumers are in very good shape. James Fraser at Citi says the US economy remains relatively resilient. What that's telling most people is that we're in a situation where there isn't a ton of excess, there's not much fragility, and if we get a downturn, it won't be a bad one. Now, what I heard this morning, Kate, that was interesting from Andrew Sheets at Morgan Stanley, said yes, maybe in GDP, but perhaps not in earnings. Could you build on that? Do you think there's a clear distinction there that might emerge that we need to pay a bit more attention to?
Yeah, I think it's a really good point. Look, we would always like to take GDP and, you know, our forecast for GDP and kind of map it against earnings. But the truth of the matter is that, you know, over medium-term periods and even over short-term periods, the correlation between GDP growth and earnings growth is very, very light, in some cases non-existent. There sometimes is a better correlation or relationship between revenue growth, the top line, and GDP growth. But companies have a lot of levers to pull and use in order to engineer better earnings. And I would expect if, you know, revenue growth meaningfully weakens and the inflationary pressures across a whole variety of goods and services don't ease, companies will do things like reduce headcount, slow down investment in different parts of their businesses that are not as profitable, all to protect the E. So you can have a weaker economic environment and actually a solid earnings environment. And, you know, John, something you and I have talked about before that's also really important is the composition of the U.S. equity market, which is, you know, some of the companies that are most important on the earnings side are less economically sensitive than, say, smaller parts of the overall market cap for some of these indices.
So let's fold that into the inventory story. We've heard from Target, from Nike, from Micron, potentially GM and Ford, according to UBS. Kate, how influential is that kind of story to the way you think about this equity market more broadly?
Yeah, one of the challenges I have, John, is that you have some of these companies talking about more difficult inventory environments. They have, you know, over-ordered, or they got, you know, too much of one seasonal good, and they're going to look to liquidate. Now, on one hand, I'd say, like, that's great for holiday shoppers, maybe a great time to take advantage of deals. On the other hand, it's pretty hard to take the examples or the stories from specific companies and extrapolate it out to the entire industry group, even though sometimes that's how the market's trading. Sometimes it's very specific around the ordering, the purchasing, and the price and sales of that specific company, and not about all of the consumer. You mentioned a moment ago, John, how many data points from financial services, from credit card data and stuff, all suggesting the consumer is still in quite good shape.
Yeah.
And that's our expectation as well.
So, Kate, you talked about the macro inflection points in 2023. The dry powder for now was for next year. Why is that? Why is next year the thing penciled in on the calendar and not the last few months of this year?
Well, look, the truth of the matter is, John, we have a lot of high conviction equity holdings in the portfolio. So it's not as if we have cut all of our risk and just said we're going to wait until the first quarter of 23. What we do own, we think, is like our strong companies with huge free cash flow potential will be able to maintain their margins through a tougher inflationary environment. But we balance that out with more cash so that we can be opportunistic. I agree, you know, to the clip earlier with Andrew Sheets that this is more likely a bear market rally than something that's sustained. And while multiples have become more attractive, there's a lot of question around the E. And you can't say the market is unequivocally cheap at this point. So I think we'll be averaging our way into companies we like that we want to hold for longer periods of time. But there's no rush to say, you know, we're breaking out here into a new bull market.
Okay, I wanted to finish with a quote from Marko Kolanovic over at JP Morgan. This is what he had to say. We trim the size of both our equity overweight and bond underweight, but remain overall overweight equities and commodities versus underweight bonds. This is the line I'd love your feedback on. Our commodity overweight continues to serve as a hedge for geopolitical risk and inflation, and we stay long the dollar as a hedge to a hawkish Fed. Can I pick up on the first piece of that last line? Kate, your thoughts on a commodity overweight as a hedge for geopolitical risks and inflation, and specifically expressing that through the equity market?
Yeah, I mean, look, we have a very constructive view on commodities and resources in general, and have actually begun to even rebuild some positions where we had taken profits in this space earlier this year, or a couple months ago, I would say. The part that's not in Marco's note there that's really important is the strong fundamentals for these resource companies. Yes, I think some of the commodity stuff provides a good hedge against macro uncertainty and perhaps some geopolitical risk, but we're also talking about companies that have very, very, very strong balance sheets. In fact, almost no debt, where the supply-demand balance is very strong, where there are secular tailwinds in terms of the transition to new energy and the metals and resources that are required for that transition. So there's a lot of fundamental reasons, in addition to the geopolitical and sort of volatility reasons, you'd want to own that space.
Kate, awesome to hear from you, as always. Let's catch up before the end of the year. I'm sure we will. Kate Moore of BlackRock there. About 10 minutes into the session, equities up 2% on the S&P, the Nasdaq up by 2.2%. Really big two-day gain on the S&P 500 to kick off this trading week. So we've heard from Kate Moore, called it probably a bear market rally. Andrew Sheets of Morgan Stanley, probably a bear market rally. And Erin Brown of PIMCO said this.
I absolutely would fade it. I think that the market right now is just coming off of, very strong weakness over the past week. We see a little bit of a relief rally this morning, but I wouldn't extrapolate that this is, going to last a very long time. I still think that there's significant challenges ahead as we turn the corner into early next year that the market hasn't digested yet. Earnings estimates are too high, margins expectations are too high, and I don't think that equities are still, singing from the same hymn book that we see in the fixed income markets.
Pushing back against this equity market move, the S&P still higher by about 2 percentage points. Up next on this program, the Biden administration looking to take more action on gas prices.
He's worked so hard to get those gas prices down by more than $1 a gallon from the highest points that we have seen just a couple of months ago. And he'll continue to work on that.
That conversation up next.
We understand that there are challenges that are in front of us here in this country. That is why the president has taken action to lower costs. He's worked so hard to get those gas prices down by more than $1 a gallon from the highest points that we have seen just a couple of months ago. And he'll continue to work on that.
President Biden looking to lower prices at the pump with midterms just 3 weeks away. This amid some recent reporting from Bloomberg revealing plans of another strategic reserve release to the tune of 10 to 15 million barrels of crude. Bloomberg's Josh Wingrove joins us now down in D.C. Josh, walk us through our latest reporting, please.
Yeah, Jennifer Jacobs, Jennifer DeLuey, and Ari Natter, our colleagues, John, are saying that they're going to announce, kind of re-announce the pending release of that 10 to 15 million barrels, which is left over from the 180 million that they announced in the spring. Now, the big question would be whether they add stuff on top of that, either a new release or something else to make it look like they're going farther than they've gone before. Remember, in the spring, that 180 was supposed to get us till fall when they said the private sector production would sort of, catch up and fill that million barrel a day gap. So, of course, after what has come since then is that OPEC Plus production cut, and it looks like they're kicking tires on what to do next. One of the economic aides, Jaron Bernstein, leaned pretty heavily over the weekend to the possibility that this is coming down the pipe. Now, of course, the midterms are the backdrop here. John, you know this, that the gas prices are ticking up a little bit, and polls tend to pretty closely track voter sentiment with gas prices. When gas prices go up, voters get mad at the president, so definitely a political lens to this one as they try to, in their view, stabilize the oil market at least.
Josh, as you know, the SPR is at a 4-decade low. Is there a conversation taking place down in D.C. about how exposed this might leave U.S. energy security next year, beyond the midterms, if this gets drained down any further from here?
A little bit of one, but not much. When I referred to Bernstein's comments, he went out of his way to say, look, it's still more than half full, so we have a little bit of wiggle room here still if they want to use it. Now, if it's just that 10 to 15, John, essentially, again, they're just re-announcing or committing to going to the full 180 that they'd announced in the spring. That's probably a different kettle of fish than if they really go above that 180 number. But, as you know, Republicans have started to sort of circle around this, and so we'll see whether they go at this particular issue. Joe Biden, in other words, has room to go still with draining the SPR, but it's kind of unclear how far he'll go without further sort of pouring gas on the fire that you talk about, saying, hey, this isn't for this.
Hey, Josh, awesome to catch up, buddy, as always. Josh Wingrove down in D.C. And to Josh's point, separately, we're still considering weighing limits on exports of fuel in the United States, too. The internal deliberations, I understand, continue. President Biden downplaying the odds of a recession. The view from Bloomberg Economics say it's 100% going to happen for a U.S. recession to take place in the next 12 months. Anna Wong joins us right now from Bloomberg Economics. Anna Wong, 100% going to happen in the next 12 months. Why?
Well, in our model, we see a significantly increase in probability of recession compared to our last update. When we did our last update in August, it was only 65%. So what drove this increase in probability? 3 factors. One, housing. We saw a sharp fall in housing permits as sales fall and construction companies decided to hold off on building more houses. Second, tightening financial conditions. The 2-year, 10-year spreads has widened. Also, we see widening in high yield spreads. Also, the third factor is just that households now have a poorer outlook about the future. And whenever they do that they will start to increase their savings to plan for rainy days, pulling back spending in today.
Anna, where are you and the team on the depth of said recession? Because what we often hear on shows like this one is short and shallow. Short in duration, shallow in depth. What are you guys saying?
Well, our baseline is still short and shallow just because we do see a lot of buffers still. And for example, I told you before, the state and local government have a lot of cash. We're estimating up to possibly $780 billion. But then I do think that there's a risk that this could be a deep one too, just because that the number one single best predictor of how deep a recession is how long is the duration of the recession. And usually when the Fed fails to cut rates early on, if the Fed does hold the rates higher for longer and decide not to cut in 2023 despite a recession, that could extend the length of the recession. And if that's the case, then it's possible that this recession, judging by the cumulative decline in GDP, could be rather deep.
Hey, Anna, thank you. Anna Wong of Bloomberg Economics. That note yesterday got a ton of attention. Equities right now up 2% on the S&P. The Nasdaq right now up 2.27%. A lot of Fed speak coming up a little bit later. You get it from Bostic, from Kashkari. Mike McKee's got to break that down. Morning, Mike.
Morning, John. Well, the problem for the markets is for years, the Fed said we're not going to raise rates until inflation goes over 2%. Right now, they're saying we're not going to cut rates until inflation starts to come down. But that's not a measure. How long is that going to take and how far are they going to do? The markets are flying blind. Now, we know that policy works with a lag. You can see there that every time the Fed raises rates, inflation took a while to start coming back down, and it wasn't until we had a recession that that happened. So is that what we're going to have to see this time? We do have a busy week of Fed speak. A lot of people on the calendar, but here's the problem with the calendar. A lot of those are introductory remarks, welcoming remarks, things like that. There's only a few people who are speaking actually about the economy going forward, including Kashkari today, as you mentioned, Charlie Evans Wednesday, Patrick Harker on Thursday. We do get the Beige Book on Wednesday, but what's the thing those three have in common? None of them are voters this year. So the markets are going to have to go into the blackout period not really knowing what the Fed is thinking about a terminal rate. They figure 75 for this meeting, but not a terminal rate. And here's what the market is reflecting there, that now we go up to 4.9%, basically 5% for a terminal rate, but two-year forwards don't come down. They really stay up high because nobody really knows where this is all going.
Mike McKee, one final question. President Bostic, he does speak today, contributing to the ongoing Fed ethics scandal of the last year or so. Mike, what have we learned about his personal situation, that particular situation, and what it means for the overall story for the Fed chair?
Well, basically, he assigned his trading to a third party who did not pay attention to the blackout rules and traded during those periods. He also miscalculated what his earnings were on his reporting forms, and so he had to admit that and correct all those. It doesn't seem like a huge issue because he didn't know these trades were being made during the blackout, but it does add to the sense of what's going on at the Fed, which can't be good for their credibility.
But the optics, not good at all over the last year for this Fed, that's for sure. Mike, thank you, buddy. Looking forward to the Fed speak, and I think many of you are looking forward to the quiet period as well that starts later this weekend. Let's get you to sector price action with a big move higher underway on the S&P, up by 1.8%. Here's Abby.
Indeed, John. We do have the S&P 500 up about 2%, up nearly 5% over the last 2 days, the best 2 days that we have had going back to October 4th. Leading the way, some of those growth sectors, including materials, discretionary, tech, industrials. On bottom, interestingly, energy is higher, but it's underperforming as oil's down. Now, over the last 5 days, it's a big risk on time, especially for financials. Leading the way, up 6.5%, really showing you that investors are pleased with earnings. Communication services, tech, discretionary, basically your mega caps, they are doing great. Yields down, we have all these big stocks up.
Abby, awesome, thank you. What a run. The Nasdaq too, the Nasdaq up by more than 2 percentage points. Monday, Tuesday, will these gains stick? Up next, your trading diary, live from New York. This is Bloomberg. 25 minutes into the session, stocks up, yields down, equities advanced by 1.6% on the S&P, up 1.8% on the Nasdaq. Your bond market taking shape looks like this: 2s, 10s and 30s, yields lower by 3 or 4 basis points on a 10-year, 397 on a 2-year, down by 3 or 4 basis points to about 440 after breaching 450 in last week's session. That's the story in the market, the price action. Here's your trading diary. President Biden speaking at noon Eastern, followed by Fed speak from President Kashkari and Bostic. Netflix reporting results after the closing bell. The Fed's beige book coming on Wednesday, plus more from Bullard and Evans, and Tesla reporting after the closing bell. And finally, another round of jobless claims on Thursday morning. Stock market up then by 1.8% on the S&P, and the Nasdaq up by 1.96. Tom Keene asked me to quote the Dow for you. I'll do just that, up by 1.6%. From New York City, I'll be out the next couple of days. I'll see you Monday. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
All right, 30 minutes into the U.S. trading day on this Tuesday, October 18th. Here are the top market stories that we're following for you at this hour. Dollar damage. J&J takes a hit on earnings and sales for this year because of the strong dollar again. We're going to speak to CFO Joseph Wolk. And a good chance of a recession. Goldman Sachs tops estimates in fixed and equity trading. CEO David Solomon, though, warns of those recession risks. And screaming capitulation. The latest B of A fund manager survey points to full capitulation, setting up a recovery in 2023 as investors add to their cash piles. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Bloomberg Markets. And Guy, I'm still looking at a rally, S&P up almost a full 2 percentage points, but the VIX stays around 30. Can you really buy the rally with the VIX around 30? I don't know yet.
I think you can buy it. Do you believe that it has any durability? I think that's probably the bigger question, i.e. is this a flash in the pan or is this something that has a little further to go? It's interesting what Morgan Stanley's talking about right now. They do see a rally. They have been very bearish. They are turning around on that. They see a short-term opportunity here, maybe up to around 4,000. And it's interesting to see what the Bank of America Fund Manager Survey talks about as well. This idea that capitulation is in. The pain trade at that point has got to be up, right? That's kind of what we're maybe seeing today.
Well, that's what we were talking about yesterday as well. And if you get earnings that come in and they're not as bad as we think, or we're re-rating earnings and they're not terrible, do you have to close out some positions? Do you have to buy the equity market, even if you don't like it? That's kind of the stressor, I think.
Absolutely. And I would imagine that a lot of people are thinking about that right now, which takes us to Alex's question of the day.
He does not like this question, so he's washing his hands of this question.
I have to ask it though. So let's dive with both feet, so both hands. How do you dive? Probably hands into Alex's question of the day. Is now time to buy the rally? Let's take a listen to what some people have been saying on this very subject.
There's a lot of uncertainty in the macro backdrop.
What we need for the market is for the volatility to go away, for everything to calm down.
We can understand why people are naturally nervous given everything that's going on.
That's what the market's going to start pricing in first, is a softish landing, and that's going to drive this rally.
I think the sell side actually has gotten too bearish on the earnings growth in the near term.
There are buying opportunities here.
The way to think about this is a bear market rally.
The best advice I would give to people, and I give it to myself, is now is probably a pretty good time to buy things relatively cheaply. Don't obsess over whether the market's going to go down 10% more. It's not going to make that much difference.
Always love listening to what David has to say. Our question of the day, Alex's question of the day, do you buy the rally? Do you get it? Do you buy the rally? Do you buy the rally? Joining us now to discuss this is Liz Young, SoFi's head of investment strategy. Liz, do you buy the rally?
Poor Alex is getting such a hard time about this question. I think it's an important question to ask. And here's the thing. I do agree with Morgan Stanley that this could go on for a while. We're in a place where we don't know yet if we're headed into a recession. But here's the thing. Be careful not to declare premature victory on some of these rallies. We've seen them before this year. Bear market rallies can be really powerful, and they can trick you into thinking that they're lasting. I would caution investors that we still have not gotten to restrictive levels on policy as defined by the Fed, which would mean that the Fed funds rate would be above the inflation rate. We are far from that, and they've been very clear that they want to get to restrictive and stay there for a while. So I still think that there's some capitulation, to use that overused term, that needs to happen in the earnings data. It may not happen yet this quarter, but I think we have to be careful to not brush it off the table as it's never going to happen for the rest of the year or early in 2023.
Liz, I appreciate the support. Which to, everyone's point, a bear market rally can still have legs even if it's still a bear market rally. I understand that you're kind of looking towards what is neutral. We can't really buy equities with a long-term conviction until we get there. On a technical level and other indicators, like with the VIX at 30, what does that tell you versus a VIX at 20?
Well, so you have to remember the way the VIX is measured is it's looking at volatility 30 days out from today. So a VIX at 30, there's only been, I think, 2 days in October where it was below 30. And yesterday was the 6th of 11 days in October where we had a more than 2% swing in the S&P. All those measures alone tell me that volatility is going to continue for the next few weeks. Now, there's a couple things on the horizon that could be a tailwind for markets. Midterm elections usually are a tailwind, so once we get past those, you typically see positive returns in the equity market. Here's what I would say to people about a rally that could occur in the short term and could have legs in the short term is it's an opportunity to reposition the portfolio and get ready for what would be considered very late cycle behavior and then being ready for a bounce on the other side of that. What I'm still waiting for is for this economic cycle to be reset enough where I feel confident that we get back into more early cycle performance. That would require inflation to come down, and it would require probably some more pain on growth.
What are you seeing in the earnings thus far, Liz? It's early days, there's plenty more still to come, but the early indications, and if the banks are anything to judge this situation by, things look pretty good.
Yeah, well, so first of all, bank earnings have been pretty good. I've been talking about financials for a long time now. I really like financials. I still like them here. Financials are the second cheapest sector in the S&P by valuation. And in an environment where valuation really matters, I think this is a good opportunity to get into financials, build positions if you don't have them. Earnings season broadly for the third quarter is really only expecting growth of about 3 to 4%. If you strip the energy sector out of that, growth is negative. So be careful painting with a broad brush and saying that earnings are going to be very strong. There is some weakness under the surface, and this could be a very pivotal quarter because we're seeing sales growth above earnings growth, which is abnormal, and that's been driven mostly by inflation. So as inflation comes down, I think we'll see more compression on margins.
So, Liz, what I'm having a hard time reconciling with earnings is I felt like we thought the turn was going to be in the second quarter. Then we thought the turn to the downside would be in the third quarter. Now I don't know if we're going to get it this quarter either for the fourth quarter. When do you think we're going to hit sort of peak pessimism within the earnings season?
I think towards the end of the year, we probably hit peak pessimism, and that's when CEOs will be forced to give guidance for full year 2023. Now, a lot of CEOs have already been very conservative, and there have been revisions downward, and then we've just sort of beat that lower bar. But in 2023 is where the rubber really hits the road, and we're going to find out whether we have earnings growth year over year for that calendar year. Now, the good news is the market always falls first. So much of the market drawdown that we've seen has already happened. We've priced in a decent amount of that bad news. If we get to a point where people are expecting an all-out earnings recession and then an economic recession, the market probably has to draw down a little bit further and get beyond that 30% down mark. And that's why there's still a lot out there of people saying we might need to get down to that 3,300, 3,200 level.
Liz, I'm hearing a lot of people saying you just want to hang out in cash. I'm hearing a lot of people also saying just buy the 2-year. It's yielding 4.4. Just wait and see what happens and just park your money there.
I don't think either of those are terrible approaches. Now, I've said this a couple times in the last few weeks. It's more important to miss the bottom than it is to call the bottom. And having cash when the market stabs down is actually going to protect you quite a bit. But you don't want to be completely uninvested. And think about how much we've gone down already this year. We've seen a drawdown at worst of 25%. Now, even if the market went down to, let's say, 35%, worst peak to trough, right? I'm still okay with buying at about 20 to 25% down and waiting for the rest of it to flush out and staying in it. Now, that all is a function of time horizon, but in order to buy, you have to have cash available to execute those transactions. This is not a time where I think a lot of people want to be liquidating portfolios either at a loss or before that position might see a nice comeback. So you do have to have some dry powder on the sidelines.
Hey, Liz, before we let you go, do you buy treasuries at all? Is that a safer place to be too?
Look, I have liked treasuries. This is obviously a yield on treasuries that we haven't seen in many, many years. Of course, it could go higher, but I think at this level and with all of the sort of pessimism baked in around the Fed and where they're going to hike rates to, I think treasuries are an okay entry point. Mostly on the short end, because if we see some sort of pause or pivot from the Fed in the next 6 months, you would see a rally on the short end.
Hey, Liz, great stuff. Good to see you. As always, it's been too long. Liz Young of SoFi, thank you very much. All right, coming up, the White House preparing to announce yet another release of its emergency oil stockpile. We're going to take a look at what that means for prices at the pump 3 weeks ahead of the U.S. midterm elections. This is Bloomberg.
earnings season is here.
Market's bracing for another big earnings season.
Everyone is expecting it to be poor.
We've had big markdowns on earnings.
Bloomberg breaks the numbers
The
first.
bar has already been set pretty low.
The big question is, can it go lower? We're seeing some pretty bad earnings already from those who have reported.
With exclusive expert analysis.
Which aspects of the market are not sufficiently priced?
Is this a macro huge headwind? There is some really bright light at the end of this tunnel.
When is this floor going to come? When can I start buying?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The White House is planning to announce another release of about 10 to 15 million barrels of oil from the Strategic Petroleum Reserves this week. This is the problem, the white line. This is current inventory in the SPR. We haven't seen this level in a really long time, just how much oil is actually left that they can release. Let's get some more insight here with Bloomberg White House reporter Josh Wingrove. Josh, it's a nerdy oil question, but how much can they release until we're at critical levels here? Not to mention that there's a mix of the oil in the SPR that actually can be helpful or not to refiners.
You know, that is a great question. They believe that they have room to run still. I mean, Jared Bernstein, one of Biden's economic aides, was on TV this weekend saying, look, the SPR is more than half full. We have room to do something here. He also said that Joe Biden hasn't made a decision yet. That was as of Sunday, so we'll see. Our reporting from our colleagues Jennifer Jacobs, Jennifer DeLuey, Ari Natter, is that this decision or announcement of some kind will come this week, and that there's three sort of buckets here. One is that 10 to 15 million barrels. Important to note that is from the 180 that they've already announced. In other words, they'll announce that they're going to fulfill it rather than maybe leaving open the question about whether they will. The second thing is that they're expected to start detailing buyback opportunities that might be aimed to quell the very question of how low are you willing to go on the SPR. And the third is there's an ongoing discussion about whether to limit exports of gasoline and diesel fuel in particular. That remains a live ball, it looks like. It doesn't seem like there'll be a decision before the midterms on that one. So lots of moving parts here. Joe Biden, though, of course, has said that gas prices are still too high in the wake of that OPEC plus production cut. And of course, he's 3 weeks out of midterm elections, where if gas prices are rising, that'll be bad for Democrats.
Does the president have that long when it comes to diesel prices, Josh? Diesel prices are spiking sharply at the moment. On both sides of the Atlantic, there is huge demand for it. Our colleagues have been writing about this, Javier Blas in particular. If this continues, this is a big problem for U.S. trucking. Can the president wait?
It's a good question. I think that it's a live ball, like I said, with them right now. I mean, whether they can wait or not, we'll see. But they would view this for sure as a supply chain issue, right? I mean, they have linked a lot of the inflation discourse to supply chain issues, including on transportation, and diesel shortages, of course, would just put gas right back on a fire that they've been trying to put out for, nearly 2 years now. And so that's where they are on that one. But right now, it seems like you get a different answer no matter who you ask. And so, I guess, Guy, I would say keep reading Jennifer DeLuey and Jennifer Jacobs' stories, and we'll see on that. But they're essentially being mum on it.
Josh, you're also right outside the White House. You're seeing sort of a convoy of oil executives. That's my way of asking, are they talking to oil executives?
I mean, it sounds like they've been in consultations with it. We don't really know right now. Biden's focus today is going to be a different thing. We're reporting that he's going to pledge later today that the first bill he'll send to a new Congress, if Democrats win the House or hold the House and make gains in the Senate, will be one codifying Roe v. Wade into law. So his focus is different. He's going to Pennsylvania later in the week. Never a dull moment for any president. So it's unclear right now when their timing is going to be on this, and therefore the consultations. But we do think something's coming. Again, 10 to 15 million, capping out that 180 they already announced. Big question, of course, as to whether they'll go beyond that 180, which is going to fuel those criticisms you alluded to of how low you can draw down the SPR.
Great stuff, Josh. As ever, thank you very much indeed. Bloomberg's Josh Wingrove joining us from outside the White House. Still ahead, let's get back to the corporate stories. Another company cutting sales outlooks due to upcoming economic headwinds. Joseph Wolk, J&J's CFO, up next. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Chinese junk dollar bonds had dropped to a record low as the property crisis is showing few signs of improving. The notes are dominated by real estate firms and the average price fell below 56 cents. It has hit that level before in August, before government support fueled a rally. AT&T is counting on stimulus dollars to help fund its broadband push. The wireless giant wants small towns to use federal economic recovery money to cover the cost of landline, high-speed internet to rural and remote areas. The CEO met with local politicians and residents in Indiana about using American Rescue Plan money to cover a portion of its fiber network expansion. An ex-Goldman whistleblower demands £20 million over firing Thomas Doyle, says reporting regulatory failures lost him a job. Goldman denies allegations and accuses Doyle of puffery. And that is your latest Bloomberg Business Flash. Alex.
All right, Ritika, thank you so very much. Let's get back to the earnings story here. So J&J reporting numbers. They had to wind up cutting their outlook for the rest of this year based on a stronger dollar. So let's get more on this with CFO Joel Wolfe joins us now. It's really good to get your perspective. You had to lower guidance in April, then again in June, and then again now due to the stronger dollar. What's your level of confidence that this is the worst it'll be in terms of the dollar impact?
Yeah, good morning, Alex. It's a pleasure to be here with you. That's really hard to predict. Well, how we measure the performance of our management teams is really on operational basis. And if you look at the third quarter, all three groups within our company actually accelerated growth over the second quarter. To put it in perspective, it's been worth about 5 points of growth to the total company on a year-to-date basis. That's our outlook for the year as well. And then about 68 cents per share on the bottom line, so not insignificant there, about $1.8 billion. We do hope that there'll be some leveling off. We've looked at charts over the last 35 years. When you see such a precipitous move, and it's only happened 2 or 3 times over that time horizon, there usually is a leveling off. Obviously, the U.S. Treasury, with its tightening of fiscal policy, needs the rest of the world to kind of catch up, and hopefully that'll occur in the coming quarters.
Joseph, one of the reasons, good morning, it's Guy, one of the reasons why the dollar is doing as well as it is at the moment is because we've got a relatively strong U.S. economy compared with the rest of the world. What are you seeing in that economy? What kind of headwinds do you think you're going to be facing? What's the position right now?
Yeah, so Guy, you may have noticed in our print this morning, we'd had about 170 basis points of gross margin erosion from the third quarter of last year. So we're dealing, just like every other industry, every other company, with inflationary impacts. That being said, a lot of our growth came from outside the U.S. We had 12% growth outside the U.S., 4% in the U.S. So what we know about healthcare and the business of healthcare is that while really there's no immunity to a recession for any company, we think our business, our industry is much more resilient than most. So we think we're in pretty good shape for the outlook. We're managing the challenges now. The team's doing a great job minimizing the impact on gross margins through other cost initiatives. And we think we're well set up, not just to close out this year as we guided today, but for next year as well.
So that's the demand side. Joe, can you talk a little bit about the input costs and that rising inflation? Can you help me understand when you think inflation will peak for you guys? Or is it like a rolling ball of inflation? Does it pop up in one area and then go to another area and then go to wages, for example?
Yeah, so we're finalizing our plans for 2023. Some of the product we manufacture in 2022 will flow through the P&L in 2023. So you'll see that still persist. But I would think right now we don't have the, I would say, input constraints, so the availability of materials, that seems pretty much behind us at this point, and now it's really just absorbing those extra price or cost increases. I think those could persist for a little bit longer, but I don't see them getting much worse, and I would hope that as some of the forecasts on your show and others have indicated, maybe in the second half of next year we'll see an alleviation of that. I think it's much harder to expect a cost decrease when the prices have already been raised. In our business, obviously in pharmaceuticals and medtech, that is not an option to raise prices, but we have taken strategic price increases in our consumer business, and what's nice about it is the iconic brands we have there, customers still value and want those brands in their medicine cabinets.
In terms of the consumer spin-off, just update us. What is the latest on that? What is the timeline? Is everything on track from your perspective?
Yeah, really pleased, Guy, with the progress we've made internally in terms of separating those businesses. We aim to get to be with a company within a company and then have a capital markets transaction in some form yet to be determined in the middle of next year. We're going to update investors either late this year or early next year as to what our path may be. We've got a number of great options ahead of us. We did have the chance to name not only the company but also a chair designate in Larry Merlo, who used to run CVS, to be the chairperson for that business. So we think we're very well positioned to have great success, not just for the new consumer health company known as Kenvue, but also the new Johnson & Johnson made up of medtech and pharmaceuticals.
So to that point, how do you beef up the area of the drugs and device area? Is it going to be acquisitions, more deals, JVs? And I'm curious as to how you reconcile that with the current macroeconomic environment.
Yeah, so you just heard on our call from both Jennifer Talbert, who runs our pharmaceutical business, and Ashley McAvoy, who runs our medtech business, that our current portfolio of products, those that are on the market today, as well as those that are in the pipeline, is very, very strong. That being said, we had free cash flow generated year to date of over $13 billion. We feel very fortunate and are proud of the fact that we were able to distribute almost $11 billion to shareholders through dividends, as well as a share repurchase program announced last month. But we still sit on $34 billion of cash. So we're very aggressively looking at ways we can complement our portfolio with strategic assets that make financial sense.
Joseph, I'm hearing from other big vaccine makers that they're not seeing the demand going into winter they would have expected for COVID. What are you seeing? What is the future of that business within J&J?
Yeah, earlier this year, Guy, we suspended guidance on that product, and we only committed to those advanced purchase agreements that we had throughout the globe and meeting those. It was never really a financial driver for our business. We always focused on a much broader and much deeper portfolio. So for us, we're going to commit to fulfilling the obligations that we have, but really not much more than that. But I have heard something similar with respect to the demand for COVID vaccine. Apparently declining a little bit.
Joseph, it's great to catch you up. Really appreciate your time on such a busy day. Thank you very much for sharing some of it with us. Joseph Wolk, J&J CFO. Thank you. Coming up, Goldman Sachs beating estimates thanks to its traders once again riding to the rescue. The banking giant preparing for yet another reorganization. We're going to get the insights on what is happening here from Chris Kotowski, Managing Director over at Oppenheimer. That's next. This is Bloomberg.
1 hour into the U.S. trading session. I mean, we're still up by 1.5% on the S&P. The last 3 days have been something. Abigail Doolittle is tracking those moves. Abigail?
Yeah, very solid gains indeed, Alex. Take a look at that S&P 500, as you mentioned, up 1.5%. We also have the NASDAQ higher, big tech, and then the Russell 2000 small caps really outperforming, up 1.8%, getting a bit of a boost on the down dollar over the last few days. The 10-year yield, you can see, is down. So yields down, stocks up, of course, really creating a slightly better valuation on the day. Now, relative to the Russell 2000 and the bear market rally last week, we took a look at a number of charts that suggested we could see a nice bounce. That's true, too, for the Russell 2000. If we go into the Bloomberg terminal, we will see that the index is rallying toward its 200-day moving average. Overall, though, on the year, over the last year, a big downtrend, a big bear market. But you can see the Russell 2000 hitting support here. It's very likely that we see a bounce back up toward that 200-day moving average for a roughly 20% rally or so, bear market rally. And the reason it's likely to be a bear market rally is that area of congestion, it is bearish only because of the descending action of it. The sellers more enthusiastic than the buyers. Let's see what happens. Of course, that's not a guarantee, but it does look very strong. As for some of the performers over the last few days, if we take a look at the banks over the last week on earnings, a very strong performance. JP Morgan, obviously, they beat, well, not obviously, but they did beat. They put up a nice beat. They also reported record net interest income. On the other hand, today we have Goldman Sachs out, and I know Sonali will be talking more about this in a moment. While their FICC beat by, I believe, 41%, their investment banking down 57%. Morgan Stanley, the laggard of the group, if you can call up 3.6% being a laggard. This, of course, as their investment banking was disappointing. And then, interestingly, Guy, we do have, we had some positive data out in the last hour. Capacity utilization beating. We also had industrial production, factory manufacturing higher, and as a result, we can see some of these important sectors such as automobiles and aerospace higher on the day.
Yeah, but it's good news, bad news. That's the question the market keeps asking itself. Abigail, thank you very much indeed. As Abigail mentioned, big focus on the banks as well. Goldman Sachs, its traders are once again helping to rescue the bank's earnings results from a sharp slowdown that we are currently seeing in investment banking. Goldman's CEO, David Solomon, addressing some of the challenges in an analyst call in the last hour.
Global economy continues to face significant headwinds. Inflation remains high. Central banks are raising interest rates at a pace not seen in decades. Meanwhile, equity markets are well off the recent highs. Geopolitical instability and energy shocks are an ongoing concern, and GDP growth expectations are declining.
Sonali Basak was, of course, on that call. She joins us now. Sonali, traders riding to the rescue once again. Is that a good thing? What did we learn on the call?
It certainly is a good thing because they're not just riding to the rescue in a small way. They are beating by fixed income. A 41% jump is bigger than you see anywhere else, Guy. And beating in equities in a down market. They have the biggest in terms of revenue this past quarter, more than Morgan Stanley, the traditional hero in that business, and more than JP Morgan, which was the leader in the last quarter. But let's fast forward a little bit to investment banking. You were talking about it, that yes, there may be pressures into the next year, but I have to say also, even though investment banking was a little lighter as a whole than analysts had expected, advisory beat. That means Goldman Sachs and the business that it typically beats at had been very strong relative to peers. Morgan Stanley actually had the weakest of that business, the biggest drop in that business that you saw of the big five firms that tend to compete in this space. Now, consumer, I mean, this is one of the most memorable calls Goldman has ever had, I would even say, under Solomon's tenure. I know investors are listening, rivals are listening, employees are listening, because you're listening to him talk about what he calls a purposeful shift in the consumer banking business, that the relationship they had with Apple extended and amended, the vying for deposits still meaningful for the bank, but the fact also that this is not a profitable part of the firm. He does say that it is a money-losing business, but he doesn't say by how much. What he does tell investors is that it will keep the bank on target for its targets. That means you have to look for where the efficiencies are elsewhere. I will be speaking to him in about 10 minutes. I will let you know.
I'm really looking forward to that readout of that conversation. Sonali, thank you so much. Really appreciate it, Bloomberg Sonali Basak. And she pointed out also earlier that 10 times the high yield saving account rate has been raised in the last
10
year.
times
That's a lot. 10 times.
This year.
This year. All right. For more on Goldman, let's go to Chris Kotowski, Managing Director at Oppenheimer & Co. He joins us now. He personally owns the stock and has an outperform rating and a price target of $4 483 for Goldman. Let's just start with the trading revenue, up that 11% to $6.2 billion. Can that kind of ferocious delivery of trading revenue continue?
Well, it is obviously, the thing about trading is it's always lumpy, especially on a quarterly basis, much more stable on an annual basis. And, you know, we and I think most other analysts have been forecasting a decline in trading revenues next year. But on the other hand, it may not happen because, you know, I mean, I think the world's central banks have stirred the pot to such a degree that the investors are just much more active than they were in all those years of financial suppression. So this it may well surprise us, even though I think we and everybody else is saying it's probably not quite sustainable.
Chris, what I'm hearing is it's volatile. What I'm therefore thinking is, should it trade at a discount? If Goldman Sachs is going to rely on trading in the way that it is at the moment, should it be valued as highly as the rest of Wall Street?
Well, I don't think it's particularly highly valued. And historically, if you look at most financial institutions, you know, they trade at 70 to 80% of the relative PE of the S&P 500.